your bank account isn't telling you the full truth, the number you see when you check your balance looks stable, but its real power is quietly shrinking. Today, it buys less than it did yesterday. Tomorrow, it will buy even less. And this isn't random. This isn't the result of free markets. It isn't traditional capitalism. And it isn't the basic economics most people are taught. What's happening is far more deliberate. This is one of the most precisely engineered wealth transfer systems ever created, operating openly while remaining invisible to nearly everyone living inside it. The United States government is facing a massive issue, a $38 trillion issue. That works out to roughly $289,000 for every taxpayer. If you earn $50,000 a year and somehow handed over every dollar you made, it would still take decades to cover your portion. And the number keeps accelerating. The debt is increasing by roughly $1 trillion every 100 days. At this pace, total debt moves past $45 trillion by 2030. By 2035, it climbs beyond $60 trillion. The math leaves no room for debate. This obligation cannot be resolved through traditional repayment. But here's what rarely gets explained. This reality is already understood at the highest levels. The Treasury is aware of it. The Federal Reserve has accounted for it. The Congressional Budget Office has run the projections. And more importantly, a response is already in motion. Not a strategy designed to protect you, but one designed to stabilize the system itself. The mechanism being used quietly reduces your financial strength day after day, year after year, while official balance sheets appear healthier over time. Welcome to Finance Historian, where we break down the financial systems shaping your life beneath the surface. Before we continue, like the video and subscribe if you want a clearer understanding of how money actually works. Comment below where you're watching from and what percentage of your savings is still held in cash. There's a strong chance that number won't stay the same after this video. Now let's look at something that completely changes how modern economic decisions make sense. In 1980, the average American worker could purchase a home for roughly 3 times their annual income. Today, that same home often requires close to 8 times yearly earnings. Some people argue that wages have increased, and technically that's true. Median household income rose from about $21,000 in 1980 to roughly $74,000 today. But income growth alone doesn't tell the real story. That's an increase of roughly 250%. So why does homeownership feel further out of reach than ever? Because the currency itself has been quietly weakened over time. $1 in 1980 now requires nearly $4 to match the same spending power, and that's using official inflation figures. The deeper issue is this: the real loss of purchasing power is far greater than what's reported. Why? Because the method used to measure inflation was changed in the early 1980s, altering what gets counted and what gets ignored. If inflation were calculated using the same framework as decades ago, annual inflation wouldn't appear to be 2 to 4%. It would fall closer to 8 to 12%. This didn't happen by chance, it happened by design. The Federal Reserve is publicly tasked with 2 goals: maximum employment and price stability. There's a third objective that rarely gets discussed, and it overrides both: keeping the government financially functional. Every other priority adjusts around that requirement, and the method used to achieve it is subtle, technical, and highly effective. The gradual reduction of the real value of savings to support government operations. Here's how the mechanism works. To operate, the government must borrow. It issues bonds. Investors purchase those bonds expecting a reasonable return. But there's a problem. If borrowing costs reflected true market interest rates, the system would strain immediately. On a debt load of $38 trillion, a 6% market rate would mean over $2 trillion per year in interest alone. That's close to half of the entire federal budget, consumed before funding defense, healthcare programs, or social services. So borrowing costs can't be allowed to rise naturally. Instead, interest rates are held artificially low through broad financial system interventions. And this is done using a process so complex that many observers don't recognize it as direct control. It's known as central bank balance sheet operations, and it represents the largest financial intervention ever carried out. In 2008, the Federal Reserve's balance sheet stood at around $800 billion. Today, it's close to $8 trillion. So where did the additional $7 trillion come from? It wasn't collected, it wasn't saved. It was created digitally and used to purchase government debt and mortgage-backed assets. And that single action reshaped the entire financial landscape. This approach achieves 2 critical objectives at once. First, it provides effectively unlimited funding for government debt. Second, it artificially keeps interest rates across the economy extremely low. When the Federal Reserve purchases government bonds, it creates demand that wouldn't exist under natural market conditions. This artificial demand pushes bond prices higher, which in turn pushes interest rates lower, because bond prices and interest rates always move in opposite directions. The result? The government borrows at roughly 2 to 3% interest instead of the 6 to 8% the market would normally require. That's an effective subsidy of $1.5 to $2 trillion per year, paid for by everyone holding dollars. But the brilliance of this system isn't limited to suppressing interest rates. It's the careful coordination between monetary policy and government spending, what economists call a fiscal dominance regime. In this framework, monetary policy is subordinate to the needs of government finance. The Federal Reserve can't simply raise interest rates to fight inflation, because doing so would overwhelm the government with skyrocketing interest payments, and everyone holding dollars is trapped alongside them. Consider what unfolded in 2022. Inflation surged to 9%, the highest level in 4 decades. The Federal Reserve reacted by hiking interest rates to 5.5%, executing the fastest rate increase cycle in U.S. history. But watch what happened behind the scenes. The Fed began selling bonds from its balance sheet to reduce its holdings, a process called quantitative tightening. In theory, this should have pushed interest rates even higher, since the artificial demand created by the Fed was being withdrawn. Here's the reality. The Federal Reserve sold $1 trillion in bonds, while the government issued $2.5 trillion in new debt during the same period. Who purchased all that debt? Not the free market. Foreign central banks actually reduced their holdings by $200 billion. Domestic banks bought some, but mainly because regulations forced them to, not because interest rates made it attractive. The system is carefully balanced, ensuring the government can fund itself while keeping everyday dollar holders under silent pressure. It's elegant, subtle, and almost invisible to anyone not paying close attention. The real buyers weren't everyday investors. They were pension funds, insurance companies, and money market funds, entities legally required to hold government securities, even if those securities don't provide a fair return. This is the captive market I mentioned earlier. Through banking regulations like Basel III, insurance solvency rules, and pension fund fiduciary obligations, the government has created a system where private institutions must buy government debt or face regulatory penalties that could destroy them. This is financial repression at its purest form. Not the dramatic kind, where the government directly seizes bank accounts. The subtle kind, where the system is engineered so that your money flows to government coffers automatically, invisibly, without a vote, and without most people even realizing it. Let's break down the math. Imagine you have $100,000 in savings and you place it in a high-yield account paying 2.5% interest. Sounds fine, right? But if inflation is running at 4.5%, your real return is actually minus 2%. Every year, your $100,000 loses $2,000 in purchasing power. After 10 years, your account shows $127,728, but in today's dollars, it's really only worth about $85,400. You lost $14,600 in real wealth, even though your nominal balance went up. Now, multiply this by 330 million Americans. The total wealth transfer from savers to the government and debtors runs into trillions of dollars every year. This is how a $38 trillion debt can vanish without ever being paid back. Not through default, not through economic growth, but through the systematic erosion of purchasing power. And it gets worse. The system is designed to accelerate itself. The more debt the government accumulates, the more inflation is needed to reduce the real burden. The more inflation rises, the more interest rates must be suppressed to keep debt service manageable. The lower the rates, the more negative the real returns for everyday savers become. It's a self-reinforcing cycle designed to transfer wealth quietly, efficiently, and invisibly. This creates a self-reinforcing cycle with only 2 possible endings. Either the dollar loses its reserve currency status and the system collapses, or policymakers successfully inflate away the debt over the next 10 to 15 years, resetting at a lower debt-to-GDP ratio. The Federal Reserve is clearly betting on the second option, and history gives them reason to be confident. Between 1945 and 1970, the U.S. reduced its debt from 106% of GDP to 37%, mainly through financial repression. Interest rates were capped. Inflation ran above those caps. Financial institutions were forced to hold government bonds. The result? A 25-year wealth transfer from savers to the government that eliminated roughly 2/3 of the debt burden without paying a single dollar of principal. And they're doing it again. Same strategy, bigger scale, and far more sophisticated execution. This time the tools are unprecedented. Digital currency frameworks allowing near-complete visibility into transactions, regulatory systems that capture every major financial institution, coordination with foreign central banks through entities like the Bank for International Settlements, ensuring simultaneous policy implementation across multiple economies. The timeline is already set. The Congressional Budget Office projects that, with current policies, debt to GDP will peak around 180% by 2050, then begin to decline. But this decline won't come from paying off debt. It will come from nominal GDP growth, fueled by inflation, outpacing debt accumulation. In other words, they plan to inflate away $20 to $30 trillion of real debt over the next 25 years. Here's the math. Assume nominal GDP grows 5% annually, 3% real growth plus 2% official inflation, though the real numbers may be closer to 2% growth plus 3% actual inflation. The economy doubles roughly every 14 years. A $27 trillion GDP in 2024 becomes $54 trillion by 2038. If total debt only grows to $60 trillion in the same period, the debt to GDP ratio improves from 132% to 111%. The government appears more solvent, even though nominal debt has risen by $22 trillion. The real improvement comes from inflation eroding the purchasing power of that debt. By 2038, after 14 years of roughly 3% actual inflation, $60 trillion in nominal debt has the same purchasing power as about $39 trillion today. Effectively, they've eliminated $21 trillion in real debt burden without defaulting or making a single extra payment. And who pays for this? Everyone holding dollars. Every savings account, every bond portfolio, every pension fund, every insurance policy, every retiree relying on fixed income. The wealth doesn't vanish, it transfers. From people who saved to the institutions that spent, from private hands to government balance sheets, from productive sectors to unproductive government consumption. This is why housing prices keep climbing, why stocks hit new highs despite fundamentals that don't justify valuations, and why cryptocurrencies attract billions even though they produce nothing. People are fleeing the dollar, not necessarily for foreign currencies, because every major economy is pursuing the same strategy. Toward hard assets, real estate, stocks, gold, anything that isn't a claim on future dollars that will be worth less than dollars today. The Federal Reserve can't acknowledge this publicly. Doing so would trigger the very crisis they are trying to prevent. If people truly understood that the dollar is being systematically devalued to erase government debt, they would dump dollars immediately. The currency would collapse, hyperinflation would become self-fulfilling. The strategy only works if it stays below public awareness. So they use language designed to obscure reality. Quantitative easing instead of money printing, accommodative monetary policy instead of interest rate suppression, flexible average inflation targeting instead of deliberately allowing inflation to run hot. Even when prices across major categories rise 20% to 30%, the technical language creates distance between policy and outcome. It makes people think the Fed is managing the economy, when in reality, they're managing their debt crisis using your wealth as the solution. Consider recent policy moves. Throughout 2021, the Federal Reserve insisted inflation was transitory, even as it surged from 2% to 7%. They waited until inflation reached 9% before hiking rates meaningfully. Then they paused at 5.5%, even though inflation remained above 3%. Why? Because raising rates further would push government interest payments over $1 trillion annually, consuming roughly 25% of the federal budget. They're trapped by their own debt, cannot raise rates enough to truly combat inflation without bankrupting the government. They cannot lower rates without accelerating inflation even more. This is the invisible trap every dollar holder is caught in. They're trying to thread an impossible needle. Interest rates must stay high enough to appear credible on inflation, but low enough to keep government debt service manageable. Inflation must be allowed to rise just enough to erode debt burdens, but suppressed just enough to avoid losing public confidence. This is the tightrope they're walking, and it only works if most people don't fully understand what's happening until after the process is complete. By the time the average American realizes their savings have lost 30 to 40% of their purchasing power, the government's real debt burden will have declined by a similar amount. Mission accomplished. Wealth transferred. Problem resolved. Until the next crisis, the international dimension makes this even more powerful. Foreign central banks and sovereign wealth funds hold roughly $7.6 trillion in U.S. Treasury securities. When the dollar weakens and inflation erodes bond values, those losses fall disproportionately on foreign holders. China holds approximately $850 billion. Japan holds around $1.1 trillion. In effect, these countries help subsidize U.S. debt reduction through declining real returns on their treasury holdings, but they can't exit without severe consequences. If China attempted to sell hundreds of billions in treasuries quickly, it would disrupt bond markets, spike interest rates, and risk triggering a global financial crisis, one that would likely hurt China more than holding depreciating assets. They're locked in a classic prisoner's dilemma. They know the value is eroding, but selling would cause even greater losses. So they hold quarter after quarter, year after year, as purchasing power quietly transfers away. This isn't traditional conflict. It's financial pressure operating through normal market structures. The United States effectively exports inflation to its trading partners while reducing its own debt burden through currency dynamics. Other countries face an uncomfortable choice: accept losses by holding dollars or weaken their own currencies to stay competitive, importing inflation and lowering domestic living standards. The endgame becomes clearer when you know where to look. Central bank digital currencies are being developed simultaneously across major economies. These aren't merely technological upgrades. They are control mechanisms. With digital currencies, governments gain visibility into transactions. They can apply negative interest rates directly. They can automate taxation. They can restrict or block specific transfers. They can even incentivize or force spending by limiting how long currency can be held. This represents the next stage of financial repression. Not just reduced purchasing power, but programmable control over money itself. The system evolves from quietly eroding savings to actively managing how, when, and where wealth can exist. The technology already exists. The frameworks are being built. Public messaging focuses on convenience and security, while the real agenda stays out of sight. What you do next determines whether you survive the wealth transfer or become one of its casualties. Holding cash guarantees losses of 3 to 5% per year in purchasing power. Holding bonds at current yields guarantees negative real returns for the foreseeable future. The system is deliberately structured to push people into risk assets because those are the only places with a chance of outpacing inflation, but even risk assets are dangerous in this environment. Stock valuations sit at historic highs, not because fundamentals justify them, but because capital is fleeing depreciating currency. Price-to-earnings ratios that once signaled overvaluation become the new normal when the alternative is guaranteed loss. Real estate prices that appear unsustainable keep rising because property is a dollar-denominated hard asset that benefits from currency devaluation. Individual protection starts with understanding the mechanism and positioning accordingly. Hard assets that can't be inflated away, productive investments that generate real economic value, international diversification to reduce reliance on any single currency, debt structures where inflation makes obligations easier to service over time. Anything except holding promises to receive future dollars, because every bond, every savings account, every money market fund, every pension promise, every insurance benefit is denominated in future dollars that will be worth less than today's, in the mechanism ensuring the outcome is operating right now in real time with mathematical precision. The $38 trillion doesn't disappear, it transfers from your purchasing power to government solvency, from private wealth to public debt reduction, from those who planned conservatively to institutions that spent recklessly. And the brilliance of the system, from the government's perspective, is that by the time most people understand what happened, the process will already be complete. The debt to GDP ratio will look improved. Officials will claim responsible fiscal management. Economists will publish papers praising successful debt reduction. And everyone who held dollars through the transition will be quietly, invisibly, mathematically poorer. Not poor enough to riot, not poor enough to revolt, just poor enough for the transfer to succeed without triggering public scrutiny. This is the most sophisticated wealth transfer in human history, executed in plain sight, documented in Federal Reserve papers, modeled by government agencies, and largely invisible to the people paying the price. Your purchasing power is the collateral in a debt liquidation that spans decades. The only real question is whether you recognize what's happening in time to protect yourself, or whether you'll be among those in 2035 wondering why everything costs 3 times more while your savings barely moved. The mechanism is active, the transfer is underway, The mathematics are inescapable. What you do with this information determines which side of the wealth transfer you end up on. Choose carefully. The clock is already running.